Welcome back to Lecture 3 of Value Investing in Growing Companies. In the last lecture we looked at financial instruments and asset allocation. We also went through the investment approaches available to us in form of debt, equity, currency, and other means of investing. In this lecture I want to introduce to you the father of value investing and Dean of Wall Street, Benjamin Graham. We will talk about his life successes, ups and downs, and see why investors all over the world take his principles as guidance for investing. We will also look at his famous book, The Intelligent Investor. Just like serious physicists read about Sir Isaac Newton to learn his teachings about gravity and motion, serious investors read Benjamin Graham's work to learn about finance and investments. Benjamin Graham have excelled in making good money for himself and his clients without taking big risks. His principles rely on safe investing and on finding stocks that are available at a bargain. Benjamin Graham lost a lot of his money in stock market crash of 1929 and the Great Depression. He wrote Security Analysis in 1934 after learning a hard lesson. Security analysis is still used in modern society as one of the best books to analyze and value stocks. Benjamin Graham also wrote The Intelligent Investor in 1949, which is still an all-time classic for any novice investor. Warren Buffett describes The Intelligent Investor as the best book on investing ever written. Now let's look at some of the key takeaways from his famous book. The Intelligent Investor is a comprehensive guideline for new investors. It's old, but the principles upon which it is based remains fundamental. The heart of Graham's approach includes 1. Loss minimization. 2. Developing an objective view of the intrinsic value of your stocks against market noise. 3. Sensible portfolio allocation. 4. Self-discipline. According to Graham, a normal investor becomes an intelligent investor if he does not speculate, does not try to time the market, and has a reasonable expectation of returns. An intelligent investor should learn patience, stay away from market noise, avoid IPOs, and should focus on long-term. Graham firmly believes, expecting rate of return in proportion to risk undertaken is a myth. Return depends on the intelligent effort an investor is willing to put. According to Graham, there are two different types of investors. 1. Defensive investor. 2. Enterprising investor. Graham explains, the defensive investor should be risk-averse and play safe. He should have both debt and equity instruments in his portfolio. We have already discussed all about the different instruments in our previous lectures. A defensive investor should look at well-established companies which have a long history of good dividend payouts. Graham insists the defensive investor should invest 25% in bonds. He also claims a defensive investor should contain around 10 to 30 companies from the stock market in his portfolio. He significantly mentioned that these investors should stay away from growing companies, as growing companies are normally in the limelight of stock market and they tend to respond faster on news, are riskier and volatile. His principles for a defensive investor are as follows. The company must generate a minimum of $500 million in sales. The company's current assets should be at least twice the amount of its current liabilities. The long-term debt that the company has should not exceed its net current assets. The company should have some earnings for the common stock each year for the past 10 consecutive years. The company should have a record of continuous payment on its dividends for at least 20 years. A minimum increase of at least 1/3 should be evident in its per-share earnings over the past 10 years. The current price of the stock should not be more than 15 times the company's average earnings. The current price also should not be more than 1.5 times the book value. On the other hand, Graham explains an enterprising investor or aggressive investor is the one who is willing to put more hard work in stock selection. Graham suggests the investor should focus on unpopular companies that have growing perspective, are trading at a 52-week low. Graham claims a company selling at less than net working capital per share can prove to be a good investment. He suggests the enterprising investor should be cautious when the stock is trading at 25 to 30 price earnings. We will be covering price earnings in detail later in the lectures. His key takeaways for an enterprising investor are as follows. The current assets must be at least 1.5 times the current liabilities. The amount of debt should not exceed 110% of the current net assets. It must show evidence of earnings stability, meaning there should be no deficit reports in the last 5 years. The company must also have a record of dividend payments. Because enterprising stocks are necessarily less established, it does not have to be as strong as with a defensive stock. However, there must be some current dividend. It must also show signs of growth in earnings. This criteria is fulfilled if the previous year's earnings are higher than its earnings 5 years prior. The price of the stock must be less than 120% of the net tangible assets. Graham in his book have used excellent tools like price-to-earnings ratio, price-to-book ratios, current ratio, debt-to-equity ratio, total assets, etc., along with examples of different companies. We will be covering all these ratios later in the course. Other than this, Graham insists investors to avoid IPOs, as IPOs have the salesmanship of underwriter behind them. They are launched in market-favorable conditions, which are seller-friendly and a hazard to buyer. Graham says the stock market should be treated as a business partner, Mr. Market, which tells him the daily value of his portfolio, giving indication to sell and buy according to the performances of the companies. A seller should sell when Mr. Market is pointing a very high price, and buy when it is pointing a very low price, and be indifferent at the rest of the time. The Intelligent Investor should be considered as a holy book of stock investing. It has provided me and many more novice investors the basic fundamental and principles of stock investing. I recommend every single investor to read this book. Now it depends on the investor, which type of investor he wants to be. Either he is comfortable being a defensive investor, or an enterprising investor. Whatever you choose, please choose wisely. Congratulations, we are now done with Lecture 3 of our course. I hope you love Benjamin Graham's approach. Make sure to read The Intelligent Investor as it includes a lot of examples. In the next lecture, we will be looking at what are stocks and how do stock markets work. Till then, stay blessed and happy investing.